first group of questions are essentially, what should I do now? Carol asked, or just basically said, I'm looking for advice on what to do with my investments. And without knowing her financial plan, we can't answer that. Because if Carol has 30 more years of working, I would say subjectively, this might be a good time, if you don't have a lot of stocks in your portfolio, to add stocks in your portfolio. If you have a 30-year time horizon and you were already all stocks in your portfolio, just write it out. Don't look at your account. But if Carol is retired and has a bunch of money in stocks and she doesn't have a financial plan, that's a problem, because we need to know inside the financial plan, how much do you need to make and how much can you risk inside of the plan? So we just don't know how to do that. So it all depends. What you do with your investments depends on your plan. So, Carol, if you're on the call, let's talk. If you have a financial advisor, let's try to get together and figure out what your financial plan says. And then we can give you more specific advice on what to do with your investments. But in general, don't panic. Just because the market's down doesn't mean it's going to keep going down. But just because the market's down, it doesn't mean it's a buying opportunity. Because I saw a lot of people over the last 6 months of 2021 jump into stocks, and maybe they shouldn't have jumped into stocks. You got to keep in mind that stock market is only back to where it was at last April. So it's given up about 12 months of returns. But if you go back from today until February 2020, so just before the market imploded because of COVID, the S&P 500 is up 20%. It's about 2 years. You divide that by 2. You've averaged 10% per year, even with this 15% drop in stocks. So it's about perspective. It's about how long you have to invest, and it's about your financial plan. One thing that we do is, again, we need to know what bucket does everything fit into. And that depends on your financial plan and your cash flow strategy. So Mary had something similar, and this is something we are seeing a lot, and I do want to address this. Mary said, I'm terrified of the market in the coming recession. How are you protecting my money? So I'm going to go back to the bubble chart, is what we call it, and it has all of our investment models. But I've overlaid some different things here about that. Our bucket 1, 2, and even a part of bucket 3, which is Cornerstone Income and Dynamic Income, they're essentially waiting in cash or low risk bonds for better opportunities. So they're just sitting there waiting. And the way I describe it is, we're sitting in the bunker. We have plenty of food and water. We know we might take a little bit of damage. No bunkers are perfect, but we're waiting, because coming out of this is going to be amazingly easy opportunities to make money. The problem is, if you don't have a data-driven approach, people are not going to want to jump into these bonds that we're looking at the worst. I'll never forget Christmas Eve 2008. If you remember that market environment, when we got that buy signal, I had so many angry people the last week of the year saying, have you guys lost your mind? Do you not know what's going on in the world? Why would you invest in high yield bonds, which are also called junk bonds? And I said, the signal said to buy, so we bought. We don't care what people think is happening. We care what the data says. Right now, the data says things are very, 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 very risky. We don't want to take those risks with bucket 1, bucket 2, and part of bucket 3 money. Bucket 3 and bucket 4, they're at their minimum stock allocation. So anybody in these investment models have somewhere between 30 to 50% with the rest of the money sitting in cash. That's as low as they get because they're longer term money, but they have taken some risk off the table. And speaking of risk, these numbers down here identify the percentage risk modeled. So the dynamic balanced will lose 25%, but it's also a 10 to 15 year time horizon portfolio. Over that long term, it's designed to weather that 25% and make a lot more money than a buy and hold investment. Moving out to bucket 4 and 5, long-term 25 plus year portfolios, our AmeriGuard and Cornerstone Growth and Dynamic Aggressive Growth, again, have risks somewhere between 37 to 47%, they're at their minimum, which is 70%, but the rest of the money is sitting in cash. And then finally, our always invested models, Cornerstone and Ameriguard Max, Core Stock, they're designed for your super long-term money. Hopefully you have money on the sidelines. A lot of people here are adding money every month to these accounts. Every time the market goes down, you should almost be happy, because over 25 years, compounding at 10% is going to make you extremely wealthy as long as you're consistent with it over a 25-year time horizon. So more specifically, and we'll, TAB is tax advantage bond, and tactical bond is right here. TAB is not listed on this chart because it's for taxable accounts only, but it has risks somewhere between income allocator and tactical bond. So Joseph was asking, why is his TAB and TB down? The first thing I remind people of is, we tell you, you should expect to lose around 10%. In any of our investments, you could lose 10%. Looking at them, they're down 3-ish% year to date, which is obviously a loss, and nobody likes losses, but that's going to happen. That's part of the investing process. And, quite simply, you can see the beginning of the year, here's that high yield bond chart. You could see a pretty steep drop before we got a sell signal. So we entered the year on a buy signal, and then the market started going down. And when we got out, we'd already taken about a 2.5% loss before we could get completely out. And then we've ridden it out. The other thing that happened was, as I mentioned, bonds that had less than 1 year duration still went down in value. And so I looked at tactical bond, tax advantage bond, and dynamic income. And since the beginning of the year, you can see down 3%, 3.6% for TAB, but then dynamic income's only down 1.7. But here's what's important to understand. The municipal bond market is down 9% over this time frame, and the aggregate bond market is down 10%. So if you were in a buy and hold portfolio, you would have gotten clobbered in these low risk investments versus barely down. If you go even closer in and you look at just the last couple of months, here's what I mentioned. Dynamic income is actually positive now over the last 2 months. And you've given up just by sitting in lower risk bonds. We have given up a little, but again, 5% drop in municipal bonds in 2 months. Most people use municipal bonds as a low risk investment that they think never goes down. Municipal bonds, subjectively, this is my opinion, although our data is saying you don't want to own them on a shorter term basis, municipal bonds are looking at a pretty tough environment. They've lost the stimulus money. Most budgets didn't count on them losing stimulus money. We're possibly looking at a recession. We're looking at inflation. And when you look at the pensions that all these municipalities have, easy for me to say, a lot of them are invested in aggregate bonds or municipal bonds. They've lost 10% in just a few months. That's a problem. That's something that is going to weigh on how much they have to chip in to pension plans. So I'm quite happy with how tactical bond and tax advantage bond and dynamic income and income allocator have performed, specifically because they were fully invested to start the year. They saw the risks in 5 or 6 weeks, they got out, and they've been riding it out, again, in the bunker, plenty of food and water, taking a little bit of damage, but we're just sitting there waiting for better opportunities. Ed asked, first a statement, I invested in a significant amount of my retirement savings in SEM accounts, expecting preemptive management moves. What happened? And so I saw Ed's full name, and so I did take a look at his account, but I'm going to first start with a blend of models and looking at the last 3 years, because this is important, because Ed started with us almost exactly 3 years ago. Ed is in our growth model. He said he had a 25-year time horizon and a 40% risk tolerance. So Ed said he could risk 40%. His account right now is down about 12% year to date. So when Ed opened the account 3 years ago, he said, I'm okay with 40. Now he's down 12, and he's saying, what the heck's going on? I thought you were going to do something about that. And I'm not slighting Ed one bit, because I think most people feel that way. When you lose 12% in 5 months, that becomes a concern. We forget what the portfolios are designed to do. But if you go back 3 years, that portfolio is up almost 22%, even with the 12% drop over the last 5 months. And then I included our moderate and our preservation models, which are all up over this 3-year period. And as a reminder, those buy and hold bond funds, which are a big component of bonds, are a big component of our moderate preservation and even our growth allocations. Buy and hold bonds are now negative for 3 years. So if you buy and hold bonds in a 60-40 portfolio, you're negative on that portion of your portfolio. Looking more specifically at the growth account that Ed is in, you could see 3-year returns, 10% compounded. The risk, he's actually in this one's a 26% risk, even though he told us he could accept 40. We're down about 12. Going into it, we're fully upfront. If you're striving for 10% returns, you're going to risk 25, 30, 35% to get there. We may only be halfway through this bear market in terms of losses. We may only be a third through the bear market. What always happens, again, SCM's been around for 30 years. I've been doing this for 25 years, is the first section of that bear market, SCM's going to participate a big chunk of it, especially on the growth side. And that's because going into a bear market, we were in a bull market. In a bull market, we're fully invested. We had a great 2020, a great 2021, because in our growth side, because we were fully invested. The bear market started, we went down with the market, and then we started to make changes to our portfolios. So Ed joined us at the very beginning of, the very end of a 12-year bull run in stocks. He enjoyed a very quick 6-week bear market where SCM took action, and 2020 ended up fine. But what is being missed is all the changes that have happened as it became apparent that maybe we're heading into a bear market. So I took this chart and I kind of wanted to walk through, this is the S&P 500, and I wanted to walk through what we've seen happening all the way back in October. And you could see October, November, and December, the stock market went up pretty nicely. But our economic model gave us a warning, and it went from a bullish signal saying, hey, growth is great right now, to a neutral signal saying economic growth might be slowing down. So our dynamic models actually reduced stock exposures a little bit because the economy was slowing down. Then you get to the start of the year, and you can look at almost from day one of 2022, the market started going down. Our AmeriGuard and Cornerstone portfolios, which were very heavy in growth allocations, started selling their growth allocations to start the year. Then over about a 4-week period, all of our high yield bond and emerging market bond systems jumped out. And by the beginning of February, all of our tactical bond and tax advantage bond had sold all high risk bonds and moved to what are low risk bonds. So again, they entered the year in a bull market, they got out pretty quickly. The market rallied and then it sold off. And then our trend indicator for Cornerstone and AmeriGuard triggered. So it sold a portion of our equity exposure in those models. And then on February 22nd, which was 2 days before Russia invaded Ukraine, is we got a sell signal, and then the market rallied. So then you would say, why in the world did you sell? Look what you missed out on. But again, we don't know what's going to happen in the future. What we know is based on history, when the market got these sell signals, the chances of it going down were much higher than it going back up. And with hindsight, now the market's below where we were at when we got those 2 sell signals. But then fast forward and almost near the top of this last rally, our economic model in dynamic income and dynamic aggressive and dynamic balanced gave a bearish signal saying, we think economic growth is going to be slowing significantly enough that stocks are probably going to be hurt. And that reduced our stock exposure there. It got rid of all stock exposure and dynamic income. It goes down. And then near the end of April, our AmeriGuard and Cornerstone bond allocations hit a sell. So when the trend indicator for Cornerstone and AmeriGuard back here in February and March gave us the sell signals, that normally goes to an aggregate bond index fund. Well, there's a trigger to get us out of that fund. So even though our stock signals ended up being okay, the bond side of that was hurting us. Well, now even AmeriGuard and Cornerstone have cash instead of bond exposure with those portfolios. And now you can see where we're at as of this about an hour before the webinar started. The S&P's fighting to hold 4,000. So you could see all the different maneuvers. So when Ed said, I thought SEM would preemptively do that, we did. And you could see October, we missed out on a rally because the dynamic models said we're going from bullish to neutral, just a little bit, not a lot. And then once things started going down, you saw how quickly our high yield bond system started to trigger a tactical bond, tax advantage bond, income allocator, and then dynamic income. So we've done things, but again, if this is a true bear market, we're in the very early stages. We're maybe only 1/3 to 1/2 through. It's that second 1/2 to 2/3 that is very scary. That's when you get capitulation. That's when you get despondency. That's when everybody gives up. Right now, everyone's still looking to buy the dip. And I'm not saying we're in a bear market, but I am saying if this is one, it's very, very early. And you shouldn't jump to conclusions and say, just because this is how the first 1/3 went, this is how it's going to be overall, because our systems are working exactly like they've done over the last 30 years. Just as a reminder, again, our short-term buckets are waiting in cash or low-risk bonds. Our middle bucket ones are minimum 30 to 50% equities. Our longer-term growth portfolios are 70% stocks, 30% cash. And AmeriGuard, Cornerstone, Max, and Core Stock are always invested. One thing we're trying to do is minimize losses. The yellow line is the amount of loss you have. The blue line is the percentage you need to recover. The easy way to understand this is if you lose half of your account value, you need to double or make 100% to go back up. Most of our clients fall in around this 20 to 25% risk category. So they have a blend of some tactical, some dynamic, and some AmeriGuard. But what this chart shows is right around that 20 to 25%, you don't have to make a lot back up on the upside. 33% gain to recover a 25% loss. In a bull market, that can be done in 1 to 2 years. Because when you get to that despondency, you have a lot more opportunities. The other thing I want people to understand is we feel losses psychologically twice as much as we feel gains. So losses hurt us twice as much than the joy that we get from that. And one thing to understand is our brains are programmed. When we look at our account value, it becomes our money. So if you log in and you see $1,001 today, and you log in and see $999,900, you just felt a loss because now you're no longer a millionaire, even though you don't really experience that loss until you need the money. And one thing we found is the more often you look at your account, the more often you're going to experience a loss. Looking at a balanced SEM model versus S&P 500, if you log in every day, 46% of the time it's going to be lower than the day before. If you log in every month, 36% of the time it's going to be lower than the last month. If you log in once a quarter, which Axos sends statements once a quarter, about 30% of the time you're going to have a loss. If you only look once a year, on average, only 16% of the time are you going to have a loss. If you're in an S&P 500 fund, about a quarter of the time you're going to go through a loss. But here's the important number. If you only look at your account every 3 years, going back through the history of SCM in this balanced portfolio, which is again where most of our clients fall, 2% of the time would you have been negative. So you're creating emotional pain by looking at your account every day. Now, it's your money. We don't want you to think, oh, I shouldn't be looking at my accounts. I don't, we want you to look as often as you feel is necessary, but just know, unless you need this money in the next 3 years, what's happening right now really doesn't matter. And more importantly, if you did tell us you needed this money 3 years from now, we probably would have told you don't invest it with us. Because if you don't have at least a 3-year time horizon before you need all of the account, this doesn't mean taking money out every month for living expenses, but if you're going to need a bulk of this investment 3 years from now, you shouldn't invest it in anything. Find a long-term CD, find a money market account that has a higher yield, because every investment will have losses. We're designing everything around the 3-year time horizon. So again, if you only looked every 3 years at this balanced account, it would have only been negative 2% of the time. That includes going through the 2000 to 2002 bear market. That includes going through 2008 and 2009. That includes 2011. That includes 2015 and 2016. That includes 2018. All those were losing years. All those were years where we had more monthly losses than we had monthly gains. But over that 3-year period, you're only down 2% of the time. So don't create those emotional units by looking at your account too often. That's what leads to, and I'm not talking about just SEM. I'm talking about your retirement accounts. If you don't need that money, why are you logging in all the time? 24% of the time, the S&P is going to be negative over a 3-year period. So again, your time horizon is very important when you look at that. So last question on what should I do, I believe, came from Robbie, and he said, why am I better off staying in such a volatile market rather than cashing out to protect my account balance? And the answer is pretty simple, is we're already down probably 1/3 to 1/2 of what a bear market is going to be. SEM's already taken measures to protect during the next 1/2 to 2/3 decline. What you're missing out on is some pretty significant potential gains because valuations have adjusted. We're not there yet, but 2009, this is tactical bond. It made almost 40% in 2009. Even a lesser year, you look at 2016, it made 7%. You look at 2019, it made 6.5%. 2020, it made 10%. Whenever we've had lean years for tactical bond, value has been created, and then we have this chance to jump in at much lower value. So with just tactical bond, if you go all the way and just cash out, you're giving up some potentially very big returns on the other side of that. In general, if you look at the normal pattern of investor behavior, you can see that buy and hold, the average investor always underperforms buy and hold investing. And that's because they cash out at the wrong time. And especially if you look at the bond market, bonds have gone through a 10% drop. I'm hearing a lot of people cashing out. The average bond investor over the last 20 years has barely made any money. You compare that to tactical bond, which has made after fees almost 6% per year over that time frame, which isn't much less than the average stock investor. All of that for risk that was less than 10%. So only reason I would cash out is if you need that money in the next 3 years. If you don't need the money in the next 3 years, don't completely cash out of the markets. Don't give up on the markets. It's coming around. So